Alright, so what's going on, guys? It's Josh back. This is day 7 of the boot camp, and today we're going over liquidity. So liquidity is really how the market moves. The big banks that move the market. Us little retail trade, we're on prop firm, so we don't move the market. Like our orders never even really hit the market. It's all just simulation. But in the real market that we're watching, the big banks are the ones that are moving it. They're the ones getting in millions and millions of dollars worth of orders to move the market. And when they want to buy $1 million, hundreds of thousands of contracts, you need people who are selling hundreds of thousands of contracts. The contracts don't just spawn out of nowhere. When you buy one, someone else is selling one. It's an exchange. So when they're trying to buy hundreds of thousands of dollars, hundreds of thousands of contracts, what's their best way to do that when they're trying to buy that? Go and hunt people's stop losses and get them out of the market, get them selling their contracts so they can buy it. So like types of liquidity, we have equal highs, we have highs and lows, we have fair value gaps, we have like the new week opening gap, the new day opening gap, really that's it. We have like LR, we have trend lines, like all those little different types of liquidity. And then we have external versus internal. So like the external liquidity, the external highs and lows, you would see on like the 15-minute, the 1 hour, the 4 hour. And the internal points of liquidity are the little 1 minute and really the 1 minute highs and lows. So you on the 4 hour, everyone who's if they're trading the 4 hour chart, everyone who's longing right here are putting their stop below this low. Everybody who's shorting right here, they're putting their stop above this high. And as you can see, in the most instances, on at least one pair, because each pair is correlated, so if one takes it and the other one doesn't, that's like a decorrelation, a miscorrelation. Look on ES, this high right here, it comes up, sweeps it, and then makes our move. This high right here, we sweep it twice, but we sweep it, we make our move, we come up, we re-sweep it, just like barely make our move. Everyone who's shorting right here are putting their stop losses above this high. Everybody who's shorting right here, they're putting their stop losses above this high. So to make the market move down hella points, you need to hunt stop losses. You need people to get out of their positions right here. And you need people to enter longs as well. You need people out of their shorts so you can get in shorts. You need people out of their longs so then you can short their contracts. So this is external draws. 15-minute external draws would be the ones you can see on the 15-minute. Down here, external draw, external draw, external draw. Let me remove all these. If we were bullish, external draw right here, external draw right here. Whoa, what just happened? External, 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 external. All these wicks you can see on the 15-minute, these are all external draws on liquidity. Tons and tons and tons and tons and tons of stop orders, stop losses are sitting above these highs. Everybody who's shorting are putting their stop losses above this high. So little 1 minute draws on liquidity would be something like this, something like this, something like this. This is a little internal, but this is a real prominent internal. So yeah, those are all. But the thing is, with internal draws, I don't actually mark them out. I just keep them in mind. But I'm gonna just mark it out for the sake of you guys. But yeah, all these are little internal highs and lows. And then you can also see the external highs and lows on the 1 minute because time's fractal. If you can see the high and low on the 4 hour, you can see it on the hourly, you can see it on the 15 minute, you can see it on the 5 minute, you can see it on the 1 minute. Going down. 4 hour down, you'll be able to see it on every time frame. But so let's say we're just bearish. The market wants to go down and they want to get in the shorts. They think the market's going to go down. So what do they have to do? They need to get liquidity. They need to liquidity sweep something to get people out of the market so they can buy their contracts. So let's say we're bearish, the market wants to go down. You get people to buy, you get people in longs, and then there's tons and tons and tons and tons and tons and tons and tons of stop orders above this high. Everyone who's shorting right here, they're putting their stop here. So these people are their liquidity grab here. Banks are getting a ton of liquidity to move the market lower now because tons of people just got stopped out. And then it goes and makes the move lower. That's all it is. If you just know where liquidity is sitting, if you just know where liquidity is, what the drawn liquidity is, like these all stick out. These lows, there's no manipulation lower. I guess we have manipulation right here, but there's all these draws stick out like a sore thumb. Prominent low, prominent low, prominent low, tons of stop orders beneath this low. The market's going to draw to here. So you can take a trade to these lows. And then when you see something like this, you see prominent lows, the market wants to draw to these lows. And then you see a liquidity grab like this. We call it a stop raid, where everyone has their stop orders here. Banks invite sellers, put their stop orders, invite buyers, stop these people out, and then make the real move lower. When you understand those two things, then you're golden. You're golden. You just can't get caught in getting the move and having your stop loss be the manipulation and then make our move. You can't do that. So that's gonna be it for liquidity. Hopefully you guys understood that. It's just where stop orders are placed. We'll go back to here. The big banks are the ones that need to move the market, and they have thousands of positions they need to enter. They can't just buy 1,000 contracts of NQ. It doesn't work like that. They need a ton of people to sell their contracts so they can buy those contracts. And how do they do that? By drawing the market to their stop losses. So they're forced to get out of the trade, and then they buy those contracts, then the market moves. So that's going to be it today. We'll figure out what day 8 is going to be. Probably more concepts, so you guys get the hang of it. But that's going to be it. You guys take care.